This paper is from 2002, and it's the institutional memory hypothesis and the procyclicality of bank lending behavior. It's been done by Alan Berger, the Board of Governors of the Federal Reserve System, Wharton Financial Institution Center, and Gregory F. Udall, Kelley School of Business, Indiana University. Abstract. Stylized facts suggest that bank lending behavior is highly procyclical. We offer a new hypothesis that may help explain why this occurs. The institutional memory hypothesis is driven by deterioration in the ability of loan officers over the bank's lending cycle that results in an easing of credit standards. This easing of standards may be compounded by simultaneous deterioration in the capacity of bank management to discipline its loan officers and reduction in the capacities of external stakeholders to discipline bank management. We test the empirical implications of this hypothesis using data from individual U.S. banks over the period 1980 to 2000. We employ over 200,000 observations on commercial loan growth measured at the bank level, over 2 million observations on interest rate premiums on individual loans, and over 2,000 observations on credit standards and bank-level loan spreads from bank management survey responses. The empirical analysis provides support for the hypothesis. Institutional memory, the business cycle, and lending behavior. Introduction. The linkage between the financial system and the business cycle has been the subject of much investigation. Arguments that the financial system is procyclical are quite consistent with economic events, such as the credit crunch in the U.S. during the early 1990s, the Russian and Asian financial crises in the late 1990s, and the large corporate bankruptcies of the early 2000s. Many theories focus on the increase and decrease in the supply of bank credit over the business cycle in order to explain two stylized facts widely observed by regulators, practitioners, and researchers. One stylized fact is that lending often increases significantly during business cycle expansions and then falls considerably during subsequent downturns, sometimes dramatically enough to be labeled a credit crunch. These changes in lending are generally more than proportional to the changes in economic activity, suggesting that they are changes in bank loan supply that tend to accentuate the business cycle. A second stylized fact about bank loan procyclicality is that observed measures of loan performance problems appear to follow a distinct pattern over the business cycle. Past due, non-accrual provisions, and charge-offs are generally very low during most of the expansion, start to appear at the end of the expansion, then rise dramatically during the downturn. This suggests that banks may take significantly more risks during the expansion, but these risks are revealed only later because it takes time for loan performance problems to appear. Consistent with these stylized facts, Federal Reserve Chairman Alan Greenspan noted that regulators agree that the worst loans are made at the top of the business cycle. Practitioners often echo this sentiment as reflected in a recent trade publication. Human nature being what it is, lenders and borrowers frequently assume that strong growth will continue unabated. Loans made toward the end of an economic cycle are often underwritten based upon unrealistic assumptions concerning growth. Greenspan also noted that at the bottom of the cycle, the problem is not making bad loans. It is not making any loans, whether good or bad, to credit-worthy customers. Consistent with the sometimes dramatic fall in lending during the cyclical downturns, These stylized facts are also consistent with data from the Federal Reserve's Senior Loan Officer Survey, which suggests that the senior managers of large U.S. banks report that they ease and tighten their credit standards over the business cycle, even after controlling for changes in demand. Timing patterns consistent with these stylized facts are also evident in other nations, as shown in recent research. The stylized facts thus suggest that the seeds of loan performance problems are sown during an economic expansion when lower quality loans are made, and then these problems are revealed during the downturn. The specific causes behind these fluctuations in bank loan supply and performance are the subject of considerable debate. In this paper, we offer and test a new hypothesis that may explain in part why bank lending follows this procyclical pattern. We hypothesize that institutional memory problems may drive a pattern of business lending that is associated with a deterioration in the ability of a bank to recognize potential loan problems and an easing of credit standards over its own loan cycle. Specifically, lending institutions may tend to forget the lessons they learned from their problem loans as time passes from their last loan bust. The deterioration in loan officer ability is partly due to a proportional increase in officers that have never experienced a loan bust, and partly due to the atrophying skills of experienced officers as time passes since their last experience with these problem loans. This deterioration in loan officer skills results in an easing of credit standards as officers become less able to differentiate lower quality borrowers from higher quality borrowers. This loss of institutional memory may be compounded by a simultaneous reduction in the capacity of the bank's internal monitoring system to evaluate and discipline individual loan officers as time passes since the bank's last bust, because there are fewer observed problem loans to use in evaluating loan officers. As well, the capacity of external stakeholders, e.g., subordinated debt holders, equity holders, government regulators, and supervisors, to evaluate and control bank managers may also be substantially weakened as time passes since the bank's last bust, due to the lack of observed loan performance problems. Although the institutional memory hypothesis is rooted in the bank's own loan performance problems rather than the aggregate business cycle, this hypothesis may help explain the stylized facts about bank lending over the aggregate cycle because banks tend to experience problem loans simultaneously. The loss of institutional memory may have a number of adverse consequences. First, the procyclical lending behavior it produces can exacerbate the business cycle and increase systemic risk. This problem may be especially serious for developing countries with relatively fragile and less well-regulated banking systems. Second, the procyclical lending behavior could result in a significant misallocation of resources if a significant number of negative net present value (NPV) loans are extended during an expansion and positive NPV loans are denied during a downturn. Third, the cyclicality of problem loans may make it difficult for government regulators and supervisors, as well as other external stakeholders, to discipline banks because of the lagged nature of problem loans. The institutional memory hypothesis implies that banks ease their credit standards as time passes since their last loan bust. Our main tests of this easing of credit standards examine whether a bank increases its commercial lending as time passes since its last bust, controlling for other factors affecting the demand for and supply of its credit. This increase in the supply of bank credit is a necessary condition of the institutional memory hypothesis as an explanation of the stylized facts about bank lending over the aggregate business cycle. We also run related tests of whether banks reduce their loan interest rate premiums and whether their senior management reports easing their standards and loan spreads as time passes since the bank's last loan bust. The models are estimated using data from individual U.S. banks over the period 1980 to 2000, approximately 2 full business cycles. The dependent variables are taken from 3 different data sets. Over 200,000 observations on commercial loan growth measured at the bank level from the call report, over 2 million observations on interest rate premiums on individual loans from the Federal Reserve's Survey of Terms of Bank Lending, and over 2,000 observations on credit standards and bank-level loan spreads from responses to the Federal Reserve Senior Loan Officer Survey. The key exogenous variable, the numbers of years since the bank's last bust, is measured as the time since the ratio of the allowance for loan and lease losses to total loans was at its maximum over an interval that includes the current year and the prior 10 years. The regressions include a number of control variables to account for other factors affecting the demand for and supply of bank credit. We include bank fixed effects in all of our tests and also run the tests both with and without time fixed effects. The inclusion of time fixed effects makes the tests quite stringent because the findings for the key exogenous variable are based only on the variation in the bank's boom and bust cycle that is not correlated with the aggregate cycle and other factors that change systemically over time. The time-fixed effects also help control for the other hypotheses of procyclicality to the extent that these other hypotheses are driven by or correlated with the aggregate business cycle or other overall economic conditions. The remainder of our paper is organized as follows. In the next section, we explain the institutional memory hypothesis. In Section 3, we review the extant literature on procyclicality in lending and how it relates to the new hypothesis. In Section 4, we discuss the empirical methodology, variables, and data sets. We present our empirical results in Section 5 and offer some conclusions in Section 6. 2. The institutional memory hypothesis. Under the institutional memory hypothesis, the capacity of loan departments to evaluate risk and identify potential future problems deteriorates as time passes since their last learning experience with problem loans. Early in a bank's lending cycle, i.e. immediately after a loan bust, the lessons of the bank's last bust are still fresh in the memory of loan officers who have just witnessed the ex post realization of their prior loan decisions. These lessons include learning about the association between firm characteristics and risk, the success of different contract structures, the efficacy of different monitoring methods, and the best strategies for managing distressed credits to mitigate losses. Thus, as the bank starts its rebound from its most recent experience with problem loans, the reservoir of lending knowledge is at its peak because these lessons are fresh in the minds of those loan officers who survived the experience. These lessons may be particularly important for loans to informationally opaque small businesses, which are often based more on soft information about the character and reliability of the firm's management team, the firm's relationship with customers and suppliers, the local business environment, etc. As time passes since the bank's last loan bust, the level of loan officer skill tends to deteriorate. The officers do a worse job of screening, analyzing, and structuring their loans as they are originated, monitoring them after origination, and designing and implementing workout strategies when these loans become distressed. One factor that may drive this deterioration is a decrease in the fraction of experienced loan officers. New loan officers are hired and trained to replace experienced officers who leave the bank or are promoted to senior positions elsewhere in the bank. These new officers have not had the learning experience of a loan portfolio bust. Additional new loan officers may also be hired to service increased loan demand as time passes since the bank's last bust. further reducing the average experience of the staff. Of these new loan officers, some may have the talent, perceptiveness, and initiative to overcome their lack of experience, but others may not. Another factor driving the deterioration in loan officer ability is the atrophy of lending skills by some individual loan officers who have had the experience of a loan bust but have begun to forget the lessons of the past. Arguably, this may affect some experienced officers more than others. Under the institutional memory hypothesis, this deterioration in loan officer ability may result in an easing of credit standards as officers become less able to recognize potential loan problems and lower quality borrowers become less differentiable from higher quality borrowers. As a consequence, banks may pull loan applicants that might otherwise be rejected with acceptable credits and extend credit to additional borrowers. Eventually, a bank's loan boom turns to a bust, and its loan officers turn more of their attention to managing their distressed credits. This process of addressing loan problems helps restore institutional memory as officers relearn how to make good loans, how to monitor them, and how to avoid making bad loans. Specifically, loan officers will learn which combinations of loan contract terms, e.g., business collateral, personal collateral, guarantee, covenants, maturity, etc., and monitoring strategies, e.g., frequency of borrower contact, field exams, frequency and intensity of collateral reporting, used during the bank's boom minimized losses during its bust. Perhaps more important, loan officers learn which contract terms and monitoring strategies failed to minimize losses. That is, they learned which combinations of contract terms were least effective in mitigating the adverse selection problem, and which monitoring strategies were least effective in mitigating the moral hazard problem through early detection of deteriorating credits and fraud. As a consequence of the restoration of institutional memory during the bust, banks tightened their credit standards, as they are able to do a better job of separating lower quality credits from higher quality credits. By separating these pools, banks are able to reject some uncreditworthy borrowers they would have otherwise been accepted during the boom. The bank's internal loan auditing system, loan review, would seem to offer at least a partial solution to the problem of eased credit standards during a boom period. Banks invest in their loan review function in order to assess the quality and performance of their loan officers. Loan review accomplishes this through costly monitoring of each loan officer's loan portfolio. While some hard information about borrowers, e.g., financial ratios, collateral values, loan covenant violations, is helpful in this effort, it may be difficult for management to fully assess loan officer ability and effort through loan review exclusively on the basis of hard information about each lender's borrowers. It is particularly difficult when these borrowers are informationally opaque and their loans are based substantially on soft information. As a result, loan review relies heavily on drawing inferences about each loan officer's ability and effort based on the ex post performance of loans made by each individual loan officer. The loan review process includes analysis of 1. Whether the ex ante structure of a loan officer's loans helped reduce the occurrence of problem loans and mitigated losses when problems subsequently occurred. 2. The frequency of problem loans for each loan officer. 3. Whether problem loans were detected sufficiently early by the loan officer. And 4. Whether appropriate and timely intervention renegotiation strategies were implemented. The loan review evaluation helps reveal each loan officer's ability and effort, and thus reduce the costs associated with the agency problem between loan officers and senior management. However, the capacity of loan review to perform this function is likely to diminish as time passes since the bank's last bust, because there are fewer observed problem loans to use in evaluating loan officers. That is, at the same time that loan officer skills are deteriorating, the agency problem between loan officers and bank management worsens, making the loan review process less effective. Bank management could offset some of this decline in credit standards by adjusting their internal lending policies that are linked to hard information. For instance, management could reduce the amount of credit authority delegated to its loan officers over the course of the lending cycle to partially offset the decline in credit standards associated with the loss of institutional memory. Similarly, bank management could impose an incremental premium on loan interest rates or collateral requirements on observable classes of loans to compensate for the unobserved lower quality credits that are likely to be included in these classes. The impact of such blunt policy instruments is complicated by the fact that new loan officers learn at unobservably different rates, and that the atrophy of lending skills across experienced loan officers occurs at unobservably different rates. Such policies also run the risk of penalizing many good borrowers and destroying bank-borrower relationships that might otherwise be very profitable over the long run. To avoid destroying otherwise profitable bank-borrower relationships, banks could instead tacitly allow their loan officers to ease credit standards and make negative NPV loans during the boom and wait until the next bust when they can sort out the good officers from the bad. Preserving these bank-borrower relationships over the long run may be a value-maximizing strategy for some banks, even though it involves some negative NPV loans in the short run. Agency problems between bank management and outside stakeholders may also worsen as time passes since the bank's last bust. Government regulators and supervisors, subordinated debt holders, outside shareholders, and other external stakeholders have even less information about the condition of the bank's borrowers and the loan demand it faces than does bank management. Thus, they may also need to observe loan performance problems to infer bank quality and bank management quality, but face the same problem as bank management: too few observable problem loans on which to make inferences when time has passed since the bank's last bust. This additional layer of agency problems could reduce the incentive for bank managers to implement policies that address the observable deterioration in the bank's loan portfolio over the lending cycle. For example, these problems might discourage bank managers from imposing the type of rationing and pricing policies discussed above, because its implementation would likely result in the bank reporting lower profits in the short run than observably comparable banks. It may be optimal for some bank managers to hide the quality of their loan officer staff and their loan review effort from outside claimants by avoiding the implementation of these blunt instruments. Similarly, bank managers may choose herding or assume correlated risks in order to avoid the costs of separating themselves from their peers. Other managers may assume more unobservable risk by not constraining their loan officers in order to mimic unobservably stronger banks. It also may not be in the best interest of these outside stakeholders to discipline bank managers to impose blunt policies on its loan officers if these policies would be value-reducing by destroying bank-borrower relationships. Some factors suggest that the institutional memory hypothesis might apply more to large banks, while other factors suggest it may apply more to small banks. On the one hand, large banks usually have a greater separation of ownership and control, and more layers of separation between management and the individual loan officers than small banks. These characteristics would tend to increase agency costs and may exacerbate the institutional memory problem. On the other hand, small banks tend to make proportionately more relationship loans to informationally opaque borrowers in which institutional memory is relatively important. Large banks may be less inclined to make such loans because they are at an organizational disadvantage, because the soft information about these loan applicants cannot be easily transmitted to or observed by senior management. However, Large borrowers can also be informationally opaque, as suggested by empirical evidence, and recent anecdotal evidence suggested by empirical evidence and recent anecdotal evidence. Nonetheless, many large borrowers have access to public capital markets and can therefore move in and out of bank finance at different points in the business cycle. This implies that 1. These borrowers may be less affected by the banking industry's institutional memory problem, and 2. The data on quantities and prices of large loans may be subject to significant selection bias as large firms move in and out of bank loans. In our empirical analysis, we will distinguish where possible by bank size and loan size. Section 3. The related literature on bank procyclicality. Much of the research on procyclicality has focused on credit crunches during business cycle downturns, particularly on the credit crunch in the early 1990s in the US and elsewhere. A number of hypotheses for explaining the timing and the magnitude of the decline in lending were tested and found to be consistent with the data to varying degrees. These include implementation of tougher capital standards, risk-based or leverage-based, explicit or implicit, an increase in supervisory toughness, such as worse CAMELS ratings, higher classified assets, more formal actions for a given portfolio, bank retrenchment or reduced risk taken due to portfolio risks, losses, impaired capital, changed risk tolerance, etc., or reduced loan demand. The research on the credit crunch provides only a partial explanation of the stylized facts about procyclicality because it neglects bank behavior during the expansion of the business cycle and any linkage between bank behavior in the expansion and bank performance in the downturn. A credit crunch is a reduction in supply that is measured against a control period of normal credit supply, or supply during an economic expansion. If there is a significant easing out of credit standards during an aggregate expansion, as would be consistent with the stylized facts, then a credit crunch during the downturn may be the result, at least in part, of lower quality loans issued during the expansion that created problem loans and depleted capital ratios that became apparent later in the cycle. That is, the seeds of the credit crunch may be sown at the top of the cycle. Some recent research has examined the expansionary part of the business cycle to try to explain some of the stylized facts. One explanation is over-optimism. During the expansion, banks may underestimate their risk exposure and ease their credit standards, which increases the magnitude of losses when the next downturn occurs. This type of behavior may be consistent with recent theories of behavioral finance or bounded rationality. Bank lending behavior might be based on euphoric expectations associated with an investment boom driven by the business cycle, or on disaster myopia, where the subjective probability of a major shock increases as time elapses since the last shock. The paucity of data available to bank managers across business cycles may also be a contributing factor, making it particularly difficult for them to assess the systemic component of risk in their portfolios. Reduced supervisory toughness or lessened market discipline during an expansion offers another explanation of a decline in credit standards. Bank supervisors were found to soften their loan classification standards and their CAMELS ratings during an expansion, and capital market participants were found to exercise less discipline over issues of subordinated debt during relatively good periods. As discussed above, the reduced discipline could come about because agency problems are exacerbated by the lack of data on loan performance problems during an expansion. Some are also concerned that the new Basel capital regulations could introduce more procyclicality in lending to the extent that banks adopt the internal ratings-based approach. This could occur because individual borrower ratings may depend on assessed probability of default, which may be correlated with the business cycle. Herding behavior may also be a factor in explaining the stylized facts. Because of the agency problem between bank managers and outside owners, managers of different banks may ease credit standards simultaneously during an expansion to mask emerging problems, then tighten standards only when the condition of the borrowing sector has deteriorated considerably. Similarly, banks may herd because penalties imposed by government supervisors may be perceived to be lighter if many banks are troubled simultaneously, or because of contagion effects across institutions. One potential explanation for the second stylized fact, that observed loan performance problems are minimal until the end of an expansion, then rise dramatically during the downturn, is loan seasoning. Loan seasoning refers to the phenomenon that loan performance problems, such as past due, non-accrual provisions, and charge-offs, are ex post measures of bank risk-taking that generally materialize only with a lag. During an expansion, more new loans are issued, making the stock of loans relatively young and less likely to have observed performance problems. During a downturn, fewer loans are issued, so the average loan age increases and more problem loans are observed. The institutional memory hypothesis may interact with other procyclicality hypotheses. That is, the institutional memory theory does not rule out the other theories. They may be complementary. The institutional memory problem may be exacerbated by the credit crunch hypotheses, overoptimism, reductions in supervisory toughness, market discipline, herding, and/or loan seasoning. For example, overoptimism may encourage loan officers to ease their credit standards further, causing inexperienced loan officers to lend even more, and further clouding the memories of the experienced loan officers. Similarly, loan seasoning that delays the observation of problem loans may add further to the lags with which 1. Junior loan officers gain experience with problem loans, 2. Senior officers restore their memory about problem loans, and 3. Bank management and outside stakeholders obtain sufficient feedback to evaluate lending behavior. The economic significance of procyclicality in the lending cycle, driven by the institutional memory hypothesis or driven by any other source, depends largely on the extent to which the procyclicality affects the business cycle and aggregate output. Empirical evidence on the two credit channels of monetary policy transmission suggests that bank lending is important to the aggregate economy. Research on the bank lending view credit channel shows that monetary policy significantly affects the supply of bank loans through its impact on bank reserves, and this in turn significantly affects the microeconomy. Research on the balance sheet credit channel indicates that monetary policy affects lending and the macroeconomy significantly through changes in interest rates that affect the creditworthiness of borrowers by altering the quality of their balance sheets and collateral. Evidence from the credit crunch literature suggests that factors such as changes in bank capital that suppressed bank lending also had an effect on the real economy. More closely related to the institutional memory hypothesis, there is evidence that changes in credit standards may be linked to the macroeconomy. One study using a VAR methodology found that shocks to lending standards, as measured using the Senior Loan Officer Survey, SLOS, significantly affected both commercial loan volume and real output. A study that used credit terms instead of the SLOS survey data similarly found a link between credit standards and aggregate economic performance. This study found that loan rate premiums were lower during economic expansions and higher during downturns. and that this was linked to the level of unemployment over the business cycle. Okay, I'm just going to skip ahead to section 6 because if I try to bumble my way through all these weird terms, it's just going to sound like gobbledygook. And for the sake of time as well. So, section 6, conclusions. Bank lending behavior appears to be highly procyclical. Lending tends to increase significantly during a business cycle expansion, and then fall considerably during a downturn, which likely accentuates the business cycle. Observed measures of loan performance problems also appear to follow a distinct pattern over the business cycle, staying at low levels until near the end of an economic expansion, and then rising dramatically during the subsequent downturn. The procyclicality of bank lending behavior may create a number of potential problems, including exacerbating the business cycle, increasing systemic risks, misallocating lending resources, and making it more difficult for external stakeholders, capital market participants, and government regulators, supervisors, to discipline banks. We offer and empirically test a new hypothesis that may explain in part why bank lending behavior follows this procyclical pattern. The institutional memory hypothesis is driven by deterioration in the skill level of bank loan officers over their bank's lending cycle. Under the hypothesis, as time passes since the last learning experience with problem loans, the last time the bank suffered a loan bust, loan officer skills decline. Part of this decline in lender ability is attributable to a proportional increase in inexperienced lenders who have never had such a learning experience. Part of the decline in lender ability is also due to the atrophying skills of experienced loan officers as time passes since they last addressed significant loan problems. Under the hypothesis, the deterioration in loan officer skills results in an easing of credit standards and an increase in lending to lower quality borrowers, as officers become less able to recognize potential loan problems and less able to differentiate lower quality borrowers from higher quality borrowers. The easing of standards may be compounded by the simultaneous deterioration in the capacity of bank management to discipline its loan officers and reduced capacities of external stakeholders, capital market participants, government regulators, supervisors, to discipline management because of the lack of observed loan performance problems. Further, it may be optimal for bank management and bank stakeholders to allow this to occur in equilibrium, because the imposition of blunt instruments involving raising prices or rationing credit may destroy bank-borrower relationships that might otherwise be very profitable over the long run. Although the institutional memory hypothesis is based on a bank's own loan performance problems, it nonetheless may help explain the stylized facts about the procyclicality of bank lending behavior over the aggregate business cycle, because loan performance problems tend to be highly correlated across banks. We test the institutional memory hypothesis using data from individual U.S. banks over the interval 1980 to 2000, drawing data from several different sources. The main testable prediction of the institutional memory hypothesis is that credit standards ease as time passes since the bank's last bust. Our key tests are based on commercial loan growth data from individual bank call reports, in which we test whether a bank's commercial and industrial lending and commercial real estate lending increase as time passes since the bank's last bust, controlling for other demand and supply factors. The last bust is measured as the point in time at which the ratio of the allowance for loan and lease losses to total loans was at its maximum over an interval that includes the current year and the prior 10 years. we find that the coefficient on this variable is positive, statistically significant, and economically significant for the growth of both types of commercial loans, providing strong evidence in support of the institutional memory hypothesis. Running the tests for various subsamples of the data show that the main findings hold for the business cycles of both the 1980s and the 1990s, and also hold for all sizes of banks, ranging from less than $100 million in assets to over $10 billion in assets. Over both decades and for institutions of all sizes, banks are found to increase their commercial loan growth as time passes since their last bust, controlling for other demand and supply factors. The findings are robust as well with respect to the exclusion of banks engaging in mergers, to the specification of additional loan categories, and to alternative specifications of the key exogenous variable. Our main findings are also robust in the inclusion of both bank fixed effects and time fixed effects. The time fixed effects make the tests quite stringent because these effects control for the aggregate business cycle and other factors that change systematically over time. The time-fixed effects also control for the effects of other hypotheses of procyclicality, to the extent that these other hypotheses are driven by or are correlated with the aggregate cycle or other systemic factors. The findings with regard to loan pricing, however, differ by size of bank. Using the Federal Reserve Survey of Terms in Bank Lending, we find evidence that small banks, assets under $1 billion, reduce their loan interest rate premiums by an economically significant magnitude as time passes since their last bust. Although this is not a direct test of the institutional memory hypothesis, it is nonetheless consistent with the hypothesis. This finding that premiums decline as loan growth increases for small banks is consistent with the implication of the hypothesis that the loan officers in these banks may be less able to recognize potential loan problems and place more lower quality borrowers in higher quality risk pools as time passes since the last bust. Large banks, in contrast, exhibit essentially no change in loan premiums as time passes since their last bust. This finding could reflect that the institutional memory hypothesis does not significantly affect loan pricing for large banks, or that the management of these banks may implement pricing policies to compensate for some of the pooling of unobserved lower quality credits with higher quality credits due to institutional memory problems. Consistent with this interpretation, we also find that large banks that responded to the Federal Reserve's Senior Loan Officer Opinion Survey showed no evidence that the senior management of these institutions intentionally eased standards or narrowed loan spreads as time passed since the bank's last bust. The difference in loan pricing results between large and small banks may also be due to the different types of credit issued by these banks, to the different organizational structures of these banks, or to other factors. Thus, the evidence suggests that the loan officers of banks of all size classes ease their credit standards over the bank's lending cycle in terms of increased commercial loan growth in accordance with the institutional memory hypothesis. However, the senior management of large institutions may recognize this dynamic and compensate to some degree by imposing higher rates on observed risk classes of loans. Overall, our findings suggest that institutional memory problems may significantly affect bank credit standards and the supply of commercial bank credit. These findings have several potential policy implications. They suggest the possibility that regulatory capital requirements and supervisory scrutiny might be more countercyclical than they otherwise would be, to compensate for the unobserved changes in problem loans driven by institutional memory. Other theories of procyclicality that may operate concomitantly with the institutional memory hypothesis, such as overoptimism, loan seasoning, herding, and the credit crunch hypothesis, also emphasize the potential benefits from countercyclical regulatory and supervisory responses. Our findings suggest, in addition, that supervisors might act to counter an individual bank's lending cycle by becoming tougher when significant time has passed since the bank experienced its own last bout of performance problems. Our findings may also suggest how bank managers and government supervisors might adjust the way they monitor bank loan portfolios. For example, banks might groom junior officers by exposing them to more loan workouts early in their career than they otherwise would to improve their learning experience. As well, banks might allocate more seasoned officers than they otherwise would to loans that have not shown problems for a sustained period to look for more subtle indicators of future difficulties. Similarly, supervisors might expose junior examiners to banks with problem loans more than they otherwise would and assign more seasoned examiners than they otherwise would to banks that have not shown problems for a sustained period.